Just as the world economy was beginning to find its footing, it's been struck by a shock we know all too well, and one we would rather do without. Oil prices are soaring again, and inflation risks have reappeared on the horizon. The much-anticipated interest rate cutting cycle, that now seems firmly off the table, with markets pricing in hikes and central bankers openly discussing the possibility amid looming inflationary pressures. From Washington to Pretoria, policymakers face the urgent task of recalibrating their strategies. The question isn't if this shock will slow the global economy, but rather how far-reaching the impact will be and how long it will last. This is No Ordinary Wednesday, Investec's flagship podcast, where we unpack the forces shaping markets, economies, and your financial world. I'm Neo Ralefeta, Treasury Risk Solution Consultant, standing in for your regular host, Jeremy Maggs. This week, we're stepping back from the noise, much of it overwhelming, to take a clearer, big-picture look at the global economy, because this isn't just any quarter. It could well be a turning point. To help us cut through the complexity and shed light on what's ahead, I'm joined today by two of Investec's top minds, our chief economists, Annabel Bishop in South Africa and Phil Shaw in the United Kingdom. Together, they'll unpack the economic shocks rocking the globe, discuss what it means for central banks and markets, and share insights on how these shifts might impact your financial world. Our recording date and time is 11 a.m. South African time on the 31st of March 2026. The situation remains extremely fluid. Annabel, Phil, welcome to No Ordinary Wednesday. Phil, just a few weeks ago, markets were pricing in a rather benign outlook, slowing but stable growth, falling inflation, and rate cuts on the horizon. Now, the narrative has shifted dramatically. How has the conflict in the Middle East changed the global macroeconomic landscape?
Hi, Neo. That's certainly the direction of travel. The S&P 500 was close to all-time highs just prior to the attacks. And since then, it's shed about 7%. And investors have been repricing what now looks like a slower growth outlook and a risk of a nasty cocktail of a hard landing for the global economy, together with higher interest rates if central banks decide that the medium-term outlook for inflation has turned for the worse. Now, in terms of the outlook, much depends on the intensity and the duration of the energy shock. Remember, we're not just talking about oil, but gas in particular as well. And the Gulf sees flows of 20% of the world's LNG. So that's important. Our base case is that the conflict lasts weeks rather than months. So in this case, you could argue that the worst of the shock is temporary. The damage, however, to various energy facilities will reduce capacity for a while longer. So even in a benign case, oil and gas supply will be tighter than usual and therefore prices higher for a while. With regard to the comparison with previous energy shocks, we've had quite a large number of oil and gas shocks previously, and they varied in terms of their effects. I think a rule of thumb is that for each shock of equal intensity and duration, the impact on the global economy is smaller as time goes on, as the world's energy intensity has fallen and as other fuels, such as renewables, for example, have become available. But a lasting conflict over Iran could still inflict significant damage to global GDP.
I mean, the general question we hear is, after the start of the Russia-Ukraine conflict, the oil price surged quite significantly then. We're not seeing that much of a shock right now. Is there anything that explains the muted and inverted commas shock from this conflict that seems rather important than what we saw in 2022?
Yeah, it's important to remember oil prices in dollar terms remain over $100 a barrel. I think the key difference really was gas, and everyone focuses on LNG, liquefied natural gas, in this conflict. But LNG, while it's important, it makes up something like only 15% of the global gas market. And the overwhelming supply of gas is the dry gas market, which gets pumped. And in 2022, Russia turned its gas taps off through its pipelines. And so, in particular, the whole of the European continent was short of gas. And taken from a UK context, we were at something like 140p a therm in the UK. The gas price 4 years ago surged up to 600, and that had a massive effect on inflation, and the central bank had to react to that.
Now that you mentioned the gas price, I mean, there are other commodities that we should be concerned about that come out of the Strait. I'm talking about aluminium, sulfur, urea, helium. What impact would these have on manufacturing across the globe? And what should we be looking out for when we consider all these other commodities?
Yeah, you're absolutely right. It's correct to look at everything that comes out of the Gulf, and the attacks on aluminium plants means that aluminium prices rose earlier in the week. Another concern is that the Gulf is an important channel for global fertilizer. And if that channel's blocked, then agricultural yields will be reduced and therefore the risks are that food prices rise. So it's at times like this that one realizes just how interconnected the global economy is. And if you shut one part off it, then it could have severe consequences for a wide range of goods and services.
Annabel, turning to South Africa, being a net oil importer, the country feels these shocks quite keenly, more through price than supply constraint. What are the immediate impacts of this Middle East conflict on South Africa's economy right now?
Look, to unpack it for our audience, South Africa only changes the price of its petrol, diesel, and obviously illuminating paraffin, or all the general fuels, once a month. As you know, that's the first Wednesday of the month. And of course, that's calculated back on the previous month's rand cost of petroleum products. So really, April's going to reflect, and here we're talking about the 1st of April, it's going to reflect the impact of the war and the higher oil price, really in terms of our fuel increase. From an immediate effect, South Africa is an energy-intensive economy, as economies around the world are. Our supply chain is diesel-reliant, diesel-intensive, and some of the good news is that, when we start to plant in South Africa, when we start to use a lot of fertilizer, it'll be towards October this year. But of course, these price increases already are affecting, fertilizer, agricultural chemicals, and of course as well, industrial solvents, industrial products, feedstock from oil. You mentioned a number of them earlier. So there's almost a price push coming down the line, which is quite lagged. What some people would feel perhaps the war start on the 27th of February. We might see, much sooner data. And of course, you are seeing some in Europe. You're seeing the German inflation data come out, Italy, those countries where they push their price increases in. But we're, for the April inflation data, which catches this price increase, we'll only see it published in May. So for us, this is quite a long wait. I think the real direct impact's been on sentiment. We've seen the negative impact on the rand. We've seen the negative impact on our bond market. Of course, on our bourses as well. But really, from the exchange rate, it's not just rand weakness because of US dollar strength. It's actually more of the rand weakness is due to this global financial risk-off environment that we're experiencing.
Let's run some scenarios here. What happens if the war ends today? How long does it take for all of this to wash out of the system and for us to get some sort of sense of normality back to this positive momentum that we saw before a month ago?
I think that's a very good illustrative point, for listeners in particular to understand, how quickly does this all unwind and unfold. And for South Africa, unfortunately, we'd still see a petrol price increase in April because we've already paid the price for fuel, the higher cost over the month of March, for example, the rising petroleum cost in March. And of course, if the war were to summarily end today, and of course, financial markets were to believe it, then of course, you'd expect your oil price to drop, from perhaps $115 a barrel thereabouts for Brent, right back down, one would eventually look to $65 a barrel to return to where we were before the crisis, if you are hoping to scupper out all of the impact. Now, of course, there's still a lot of lags in supply, ships who couldn't get through. And, even for South Africa, we buy our petroleum products because we don't, as you said earlier, produce our own oil, but we don't produce enough of refined products off oil to meet all our diesel and petrol, jet fuel and other needs as well. So we import petrol, diesel, etc. And that obviously will come through on our supply ships that we wait for every 6 weeks. So we do have some reserves, but of course it's going to take a while for a lot of that flow to come through. South Africa gets a lot of its oil and petroleum products from India, from Nigeria, from African countries. Only a portion comes from Saudi Arabia, but nevertheless, that's still significant. We also produce quite a bit from coal, artificial synthetic fuel, coming from our Sasol refinery, and that's probably about 30% of our needs. We also, of course, can refine oil into petroleum product, not as much as we need, but of course, the kicker is we have to import the oil to do so. So, a very sudden unwind in the oil price would mean, quite a drop for the month of April in terms of the calculation of the under recovery, and it would mean a much lower fuel price for May. Of course, also as well, the question would be, would the Reserve Bank, look through the shock then from an interest rate perspective? We obviously expect it would. It already did that at the March MPC meeting, and perhaps we would evade any interest rate hikes this year. Inflation then would be a very temporary shock, as we said. But of course, there'd be a bit of a lag coming through in those later months. But that's the type of, quick end, which still has lagged effects, but those lagged effects are much less than you would expect from a longer war. Yeah.
And Phil, just to bring you in here, the comments out of Washington have been confusing. We all expect, this conflict to last another few weeks. And the question is, what if it doesn't? What if it's a few months? What does the long-term forecast on oil and global interest rates look like?
Yes, indeed. A longer conflict would probably imply a more intense conflict as well, with perhaps some sort of ground action by US troops. And that could be Karg Island or some of the other islands on the Gulf, perhaps even in extremis onto the Iranian mainland. And in that case, what you see is worse inflation numbers. You get a greater slowdown in global growth. And central banks really don't want to be caught out with permanently higher inflation, as they were arguably in 2021, 2022. So what you begin to see is central banks actually actively beginning to raise interest rates to contain the inflation threat. Of course, what happens there is that you get a further break on economic activity. And if we're looking at that scenario, which is certainly, I add, it's not our base case. It is, if you like, the most severe scenario. You see quite a slowdown in global activity. It's not impossible to see global growth falling below 2%, which some organizations such as the IMF would actually say constitutes a global recession. But of course, we all hope it doesn't come to that. And as I said, our base case is that this lasts weeks rather than months.
And there's increasingly talk about the world finding itself or heading into some sort of stagflationary environment. How do central bankers respond to such an environment?
Well, at the moment, at least the majority of central banks are just talking about possible responses and not responding. And the first impact that you see, you're already beginning to see it in the inflation numbers. Earlier this week, we had the Eurozone inflation numbers for March, which showed an increase to 2.5% from 1.9%. And that was very much an energy-based effect. After that, you begin to get some secondary effects, which is where goods and services producers begin to pass on their high energy costs to consumers. What would concern us most, and certainly concerns central banks, is if you begin to see the labour market responding in terms of higher pay growth to catch up with higher inflation. Now, those pay increases, again, increase companies' costs, and they would be fed through into higher prices, into what we call second round effects. And they would tend to result in inflation remaining higher for a prolonged or persistent period. And that would be something which central banks are already on the lookout for, just to make sure, as I said, they don't get caught out by higher inflation as they did a few years ago.
Phil, I'm wondering whether, firstly, we might see divergent responses by various central banks. And secondly, what do you think happens now to this political pressure that's been put on the Fed to cut rates? How do you think the Fed responds to this environment and against that pressure as well?
Yeah, it's a very good question. And you're right. What we're looking at is central banks at least giving us some slightly different rhetoric from place to place. So, for example, the European Central Bank is warning of hikes soon, and the Fed is keener to wait on how the situation develops. And there are a couple of reasons for those divergences. And one is concerned with the level of rates. The ECB's policy rate, deposit rate, is at 2%, and that's largely judged to be a neutral rate, i.e. the stance of policy that neither quickens nor slows the economy down. And the ECB Governing Council is judging it might be appropriate to shift to a slightly restrictive stance given the inflation threat. By contrast, the Fed's policy rate, the Fed funds target range between 3.5% to 3.75% is arguably slightly restrictive. So you could argue that that stance is already pushing hard or moderately hard against inflation. So there's less of a need to raise rates from that perspective. And the second important reason regards the mandates of each central bank. Again, I'll use the ECB and the Fed as an example. The ECB has a 2% inflation target. Meanwhile, the Fed has a dual 2% inflation and full employment objective. And given what's happening with energy prices, those targets are in conflict with each other, and that argues for less policy restraint. And of course, all economies face different circumstances. They have their own nuances. So it's not altogether surprising to hear some differences in the messaging from different central banks, and also different responses by forward interest rate markets in various jurisdictions as well. Now, with regard to the Fed, it looks pretty unlikely that the FOMC is likely to capitulate to political pressure to lower rates anytime soon. much of the outlook for rates, and specifically whether the FOMC eases policy this year, really depends on the duration of this conflict. It's not impossible that if things are resolved quickly, then later in the year, you're likely to have a new Fed chair. If he is appointed formally, that's Kevin Warsh, the former Fed governor, he may well try and put pressure on the committee to lower rates gradually. But it's very, very dependent on the situation in the Gulf and what happens to energy prices and, of course, the resulting inflation pressures. But our base case is that the FOMC does nothing this year. By contrast, we're expecting 225 basis point increases in the key rates from the European Central Bank.
Thanks for that, Phil. Annabel, I just want to bring you back home to South Africa. I want to look at three key lenses here, from a consumer perspective, from a business perspective, and from a government perspective. From a household perspective, consumer confidence was also on the mend earlier this year. Should we expect that positive trend to stall or even reverse?
Now we're talking specifically on households, and of course they matter as well because they account for 2/3 of GDP, household consumption expenditure. This really talks to consumer confidence, what's really going to happen going forward. And we did see a little bit of an improvement in recent data. There's been a trend of, modest improvement. And that was really part and parcel of the overall growing improvement that we saw in South Africa. Sentiment was picking up in terms of the economic outlook, in terms of the outlook for financial household finances, and of course as well, consumers were starting to think, okay, that would obviously have a positive impact on employment and earnings in those areas as well. Now, with fuel price increases, it still drains consumer household finances. And this is the real worry that, as we talked about earlier, do those costs come through into other consumer items as well? So yes, I think there will be a bit of a negative impact, but I think that once this crisis is over, consumer confidence will actually recover in South Africa. And of course, it'll be part of that return to the trend that we're seeing in our country, which is one of an upliftment in the investor climate and, of course, in sentiment across the board. You also see that in the business sentiment readings. For businesses, these rising costs are really, really key. It's a situation in South Africa where our producer price inflation really runs ahead of consumer price inflation by about a month or two. And for us, we obviously said that a lot of the agricultural costs will tend to come through later in the year from fertilizer, but there's still, of course, as well, the pesticides, other factors. Why would we focus so much on agriculture? Well, last year we saw our economy grow by 1.1%. Without the agricultural sector, we'd be at 0.7%. So it's a big sector. It's important, but also, of course, as well, feeds through to the consumer. And, for businesses, the bottom line really is, what is going to be the demand globally and domestically. And this is a shock that impacts global and domestic demand. While there obviously might be short-term pain from higher interest rates, of course, longer-term expectations that then pushes this jump out of the system. For government itself now, well, I think they would probably see this as a temporary interruption to that trend as well. Cutting back on the taxes would obviously provide some relief, but not full relief in any means for this fuel price jump. But also, again, the finance minister did say it's a temporary reprieve. It's not something that would be persistent. So it's unfortunate that it's happened, but I think all economies around the world are going to see the impact on their government finances. Many countries will obviously try and assist where they can from a financial perspective, but already everyone's been very, very stretched from a debt perspective because of the COVID impact and, the weak economic growth that we've seen as well. We haven't seen economies return to extremely strong economic growth globally. Obviously, there have been some uneven conditions, but for South Africa, we're expected to be on an upward trend for economic growth, out the next 5 years, rising to 3%. I don't think that changes. I don't think the long-term story changes for our government finances either. But I think, short term, there is going to be this impact. That is an absolute key story for us in that it's really, given our extremely high unemployment, South Africa really needs to see an economic growth rate running at 3 to 5% to drop unemployment. In the 2000s, that's what we had. We had economic growth even exceeding 5% for a number of years. And unemployment dropped from over 30%, which is what we have now, to, of course, closer to about 22%. But for economic growth for South Africa, of course, our infrastructure area remains absolutely key. And of course, running the infrastructure conference in South Africa at the moment, and it comes off of the back of Operation Blue Lela, where we have seen enormous progress in ending the electricity crisis in South Africa, ending load shedding, as we know, getting off the grey list and fighting crime and corruption, but also, of course, as well, focusing very heavily on Transnet and getting the goods through our ports and improving export export. And that's really the outlook for our economic growth, that strong continued improvement in infrastructure. But there's no doubt there's going to be a short-term, growth impact. And it just depends, as we said earlier, how long the war lasts for, but also, of course, how much government really can manage to absorb on the fuel price. We know, getting a sense really today, I think, of what they're going to absorb for April. But, how much longer does this persist in terms of, starting to see the impact feed down the line into producer price inflation and other effects here. So that's really, I think, the growth story for South Africa.
Phil, as we wrap up, what would you say is the single biggest risk looming over your global economic outlook at this present moment?
Yes, we're always looking at potential risks to the global economy, and there are always a variety of risks. One is perhaps related to AI and private credit, and that hasn't disappeared, but it's obviously been dwarfed by what's going on in the Gulf, and that really is the epicenter of what we're looking at right now. As I've mentioned earlier, it's really related to a protracted conflict. We know what the dynamics would be there with energy prices. They go up and they remain at elevated levels for a protracted period. So that really is the greatest risk. And as I said, it is a risk at the moment, but it's not impossible. It's not a base case.
Okay, and to both of you, we mentioned earlier about, how business and consumer sentiment has been knocked by this crisis. I'd just like to finish off positively here. Looking forward, what positivity can we extract from your forecast, and what can consumers and businesses alike look forward to in the future? Let me start with Annabel, and I'll finish with you, Phil.
Despite this, what we see as a temporary situation, in 2026, despite 2026's oil crisis, we continue to expect out to 2030, 31, that we're going to see a significantly stronger economic environment in South Africa, pulling people into employment and providing a lot more in terms of decent wages. And of course, as well, then really seeing an entrenchment of the gains we've made in terms of embedding a low inflation target of 3%. We think it's a temporary interruption, as I said, to inflation. And of course, as well, bringing in our fiscal anchors, which will help to embed a lower debt to GDP ratio, but more importantly, it will be flexible, but to improve our fiscal government finances and our fiscal credibility further. So I think that's all going to talk towards an improvement in our investor environment, and that in turn will obviously very, very helpful in terms of South Africa seeing more investment and of course more economic growth. So we really do think this is something that globally will not persist endlessly. It's going to be something which they, or certainly in our base case, bring to an end in the next few weeks, or if not a couple of months, but not something that disrupts our longer term growth environment.
Thanks, Annabel. And Phil?
Sure, yes. On the basis that this isn't a very long conflict, our forecast suggests that we'll still get global growth of about 3% this year. We've downgraded that from 3.3% a month ago. And what you see is some central banks raising rates, but not all of them. But you certainly see an interruption to the rates cutting path that we discussed earlier. And on the basis that this is relatively short-lived, inflation pressures begin to become diminished next year. Central banks can perhaps start easing policy cautiously over 2027. But I think in terms of broader implications, what we're seeing is a manifestation, we think, of globally disruptive events that have arisen from a shift in world political tectonic plates. And of course, for every reason, we hope that this conflict does end relatively promptly and we don't see many more like it. But, greater tensions around the world do seem to be part of the landscape going forward, and it would be wrong to be complacent about them.
Yeah, thank you. Well, folks, that's all for this episode of No Ordinary Wednesday. Annabel Bishop, Phil Shaw, thank you for joining me on this episode of No Ordinary Wednesday. Please join us again in 2 weeks as we continue to explore money trends shaping your world. If you haven't yet added us to your podcast feed, search for Investec Focus Radio SA wherever you get your podcasts and hit that subscribe button. Don't forget, our podcasts are now on YouTube for your listening pleasure. Till next time, farewell from me, Neo Ralefeta, and the Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.